3 more minutes and then we can start this class. So let's just give time for those that are available. They can just join now. And then yeah, you know how this thing is online. People hardly have time. Hi Tumelo, how are you?
I'm okay. How are you, Mgo?
I'm good. We're just giving 5 minutes to sort of like allow others to join. So in 5 minutes we're gonna start. So that's like 1 minute from now.
Okay, awesome.
All right. Have you been trading?
Have I been right?
Have you been trading?
No, I'm more of a beginner. I know someone. I tried to learn it, but then didn't have much time last year, so I'm more a beginner.
Okay. Did you attend the previous classes?
I've been attending programming classes, but then it's my first time attending the Forex class.
Did you at least watch the catch-up classes that we upload on YouTube?
No, I didn't. But
No.
I'll do that after this session.
Okay, so some of the things may be a little bit confusing, but it's advisable that you watch those classes just to get an idea of what's happening in the market.
Yeah, I'll do that. Thank you.
No problem. Takarani, welcome.
Hi, thank you.
Okay, it's now 5 minutes, so I think we can just start with the class, right? You guys can see my screen?
Yes, we can.
Okay, great. So today we're going to cover indicators. So I'll try to be as brief as possible. So if I'm going too fast, just don't hesitate to stop me and ask, consult. Like if you want to discuss something, you can just ask questions along the way. Is that okay? Okay, I think we did discuss that in Forex, it's all about knowing when to buy and when to sell, right? And also knowing when to hold. So if you know all of those things, then you can sort of like make more profit in the market, right? So I think when we talk about when to sell, I have a personal experience this week. So I think most of you know that Bitcoin went down by more than 30% this week, if you have been following the market. So I was holding Bitcoin for quite some time, but under another, it's like a basket of cryptocurrencies. And then now I couldn't sell like during the time when Elon was busy sending out his tweets and all of the stuff about Bitcoin not being environmentally sustainable and other things as well. So then, so the portfolio was doing well. And then after some time, after those tweets, then it went down, extremely down, right? So I think my when to sell was when the question into sustainability of mining Bitcoin came into play. Then I was supposed to sell at that time. But now with this dip, I think you guys know that when we have a dip, that means that you're supposed to be buying more. So in a way, it's good for those that haven't entered. So if you want to enter, you can also buy now, right? Okay, so I think this just goes around knowing when to sell and knowing when to buy. So sometimes the emotions can have the best of you, and then you think, okay, even if you've made a lot of profits, you're like, I can still make more, right? And that's greedy calling having the best of you. So I think knowing how to manage those emotions is good, right? So I think we should start with the indicators now. So the first indicator that we're gonna deal with is MACD, right? So then this one we're gonna talk about. It's a moving average, convergence, and then the distance for divergence, right? So I think it follows a trend, right? So it follows a trend, and like it follows the momentum of the trend. So if there's the market is trending, then you sort of like use this to find opportunities to enter within a trend, right? So say for example, bullish signal when the fast moving average crosses from below the slow moving average, right? So then you will have two moving averages under your indicator. So I'll show you after we've covered the other MACD as well. So now with these, whenever they cross, right? So it sort of like signals you what to do in the market, right? So if the market is trending down and then they cross over, then you know that the market is going to change direction, right? So if you're looking at your chart and then it was sort of like trending and then a downtrend, and then now these lines they cross over each other, then you know that okay, there's going to be a change in a trend. But with this tool, you don't necessarily use it alone. So you need other indicators such as your chart patterns, like you would have a double top, or you would have things like what do you call this? Or double bottom in this case. So you can have a double bottom, and then it will show you okay whether we've changed the direction of not or not. And then so now see after this this cross here, we have another cross here, and then if you check with respect to the chart, the market changed direction as well, but then it's still trending upwards. So it changed direction going down. So after going down, now you have another cross here. So it means that okay, the bears are no longer selling. So now you have bullish entrance. So now after this cross, the market goes up again, right? So you're just checking these crosses. So they show you whether the market is changing direction or not, right? So I think that's just basically what the MACD deals with. Okay, and then you have the MACD convergence, right? So what you have is in a trend or in a market. So say this one is going down, right? You have these this one is a bullish divergence, right? So what it means is that when you note that the market is going down in a downtrend, so you can sort of like draw a trend line showing that the market is trending down, and then on the MACD, right, it will also be forming a trend, but this trend is going up, right? So with this trend that is going up, it's showing you that now if the trend continues going up, it's showing you that the bulls are gaining strength. So if you want to buy in the market, get ready to buy, right? So now the convergence part of it is when this trend line and that trend line going up. So this is a downtrend and the upward trend. They're sort of like converging. If you check, if you extend these lines, they sort of like converging. So they will meet at a certain point, right? So they break. Usually it will break out of that convergence, right? So it goes up. Then now you no longer have that. So they'll sort of like now you no longer have that convergence, because if it was downtrending, then the market will go up, right? I don't know if you guys are following. So you have a downtrend, right? So now this is a signal that tells you whether the market is going up. Actually, it shows you that the market is going up, right? So when you want to buy into the market, then you use this trend, right? So this downtrend that you have, and then this upward trend that you have. So whatever happens is that when they are sort of like converging, they show you that, okay, over time, the bulls are getting strength. So get ready to buy, right? So this is when now you see that, okay, from here, after it bounced here, it just went up, right? So after you saw that, okay, the second bounce and then the second bounce on this one, then you just buy. Then it just shows you that, okay, the market has changed direction completely. And another signal that you can have is that you do have these two moving averages that are there. So you have these two moving averages crossing. So when they cross, it's another signal that shows you that we have changed the direction from downwards to upwards. I think I did explain on the previous one. So here on this downtrend, right, you have this confirmation of this crossing, and you also have this upward trend that is happening. On this downtrend, what you have is, after this bounce, after this consolidation here of bearish candles, you have a bullish candle going up, strong bullish candle, right? This is stronger than all the other candles that are here. If so, usually you call this a bullish engulfing. So it sort of like swallows all the candles in size that are before it, especially the bearish candles that are before it. So you had a strong bullish candle. So after the formation of this strong bullish candle, that's your second indication that the market has totally changed direction. So now you can actually buy, right? So that will be your other indication to show you that this is a now strong bullish move of the market. So which means if you're selling in this market now, you'll be losing money, right? You'll be going against the market. Are you guys following? All right. It will be great to get your feedback. Anyway, we can move on to the other one. Are you guys happy with the MACD convergence?
Yeah, I'm fine. I don't know about others.
Okay. I think you might be speaking for everyone. So for the sake of time, we can move on to the other one. So you have MACD divergence, right? So now if the MACD divergence, we established that it's used for bullish. So establishing a bullish trend. So that means that when you see the divergence, then you know that you are getting ready to buy, right? With the divergence, it's the opposite, right? So now it's a bearish trend reversal, right? So you have your trend that was going up like this, and then this is a bullish trend. Now, when you go up and then you see that, okay, you draw your trend, right? Okay, okay, can you guys assist me with admitting the people that are trying to enter into the meeting? Right, if you are able, you can just admit, but then I will try to admit them as well. So you have an upward trend that is going up like that, and then on the MACD signal here, you have a downward trend, right? So you are following the blue line. So when you follow the blue line, you see that it's forming those downwards trend. And then now what you see is that this one is going up like that, this one is going down. So instead of converging like the previous convergence MACD, this one is diverging. So they are going away from each other. So they're diverging, right? So you know that, okay, they can't keep diverging for long. So it means that sooner or later, they will have to go down, right? So now what you have here is that you have these lines crossing after this trend that you have here. You have this line that shows you that, okay, now we have changed direction, right? So when you have this line crossing, it shows you that we have changed the direction. What you're waiting for is a strong bearish candle that shows you that, okay, we have actually changed the direction for real. So you need two more indicators to show you that we have changed the direction. So candlesticks are a good indication of what the market is doing, right? So here you have a bearish candle that you can see that is fully bearish, and then compared to the other previous three candles, this one is stronger than the previous candles, right? So it shows you that the market has fully changed the direction. Then you can start selling, right? So now that's what it means with the divergence MACD signal. Okay, so let's go on to the other one. All right, you have your stochastic oscillators. So with these stochastic oscillators, they are momentum indicators. So it's usually the same with the MACD as well. So you have your areas where you have your oversold and your overbought, right? So this bottom line that you have here, the dashed one, it's at level of 20. So anything that goes below that, it shows you that the market is overbought, right? So now if it's overbought, you're most likely gonna go up again, right? So it means that the bears can no longer buy anymore at this moment, right? But then it can differ depending on the news that is there. So if you're trading a pair that has some fundamentals that are going to affect it in the coming few hours, then this may be violated, right? So if you are in the overbought area, right? So you do have this trend that you see going down like that. And then you have this region where you hardly trade this region. So you have the 20 region and the 80 region. So the 80 region and above, it means overbought. So it means that the bulls have exhausted their buying energy. And then you have your 20 below, it means the oversell. So now you have this trend that you have going down. So when it goes down, and then it's coming from an overbought line, and then it goes down like that. It goes down. So after that, it reaches the oversold region from the stochastic oscillator. So when you reach that overbought region, then it means that you have to get ready to buy, right? So oversold, I meant. So you have to get ready to buy. So now after this, you have to look at a signal that is the candles now. The candles are going to signal you whether you can buy or not, right? So you're most likely to look for a bearish, a bullish candle, a strong bullish candle. In this case, you have this strong bullish candle that was there. So now that means that you have a strong signal to tell you that you have to buy. And the lines have crossed over here. It's just that this cross is not so visible, but the lines have crossed here. Then you can buy, right? Then after buying, then you can hold for some time, and depending on your risk, then you can sell at a certain point somewhere up there. So some they rather buy and then they sell when the market reaches an oversold region, right? So what they're usually doing is they're trading the regions that are oversold and trading the regions that are overbought. So you buy when the market reaches the overbought region. So that means that if you had bought somewhere here, then you were going to be selling somewhere there, right? So you get a few pips in the market out of that. So that's just you depending on your risk appetite. And then after it reaches the overbought region, then you can sell again. When you sell again, you wait for the oversold region, then you buy again at the oversold region. So in this case, if you see here, if you had bought in this region, it was a strong buy in this region, because with the buy that was happening here, the market went up for many pips. It's just that we cannot calculate at this moment, but it's a lot of pips. So I think it came from 260 to 340, right? So this is in a long-term market time frame. So as you can see here, it's February, March, April, right? So it's a long term, right? So if you're trading this this time frame, then you would have to have a lot of money in your account, because anything can happen and then you can blow up your account, right? Or you have to be having a very, very small lot size. So what you see is that this went up, and then if you are trading this, then you would have sold at the overbought region, right? So it reached the overbought region, then you can sell, right? So you bought at the oversold and then you sell at the overbought. So that's how it works with this indicator. So then now if you were, say you enter the market at this region here, then you start selling again, right? So you sell, you wait for the oversold to be reached, then you sell, right? So that's essentially how you trade the stochastic, right? It's more or less similar to the MACD as well as the RSI, right? So the RSI is a relative strength index. I don't know if you guys have questions on the stochastic, or I can go on to the RSI. Are there any questions? All right. So on the RSI, you have it's called relative strength index. So it is also a momentum index. And then now with this one, it's behaving the same way as the stochastic. You have your overbought in the above the 70% region, and then you have your oversold below the 30% region. Whereas with the stochastic, it was below the 20. But you can also play around with his overbought and oversold level, depending on the behavior of the market. So I'll show you when we go and set it up on the MT5 platform. So you can play around with it. So if you see that, okay, you hardly have any overbought or any oversold, then you can adjust it to suit your trading needs. So which means that you can analyze this trend that is happening here. So then after analyzing this trend, then you can be able to see, okay, which ones are your main support and which ones are your main support and which ones are your main, what do you call, your main resistance levels. Okay, and then so that's how it works. All right, sorry, let me just attend to something for a few seconds. All right, apologies for that. I had to attend to something. So with the RSI, it's similar. If you're on the overbought region, then that means that you start selling, right? If you read from here, bullish signal when the RSI line is in an oversold level and the gradient is steep, right? So when the gradient is steep, it means that it's like I know you guys did maths, so your gradient is steeper. Like you can't really run up that gradient, right? So then you start if it's overbought, if it's oversold, then you start buying, right? So that's what it means. Then you have a bearish signal when the RSI line is in an overbought level and the gradient is steeper as well. So you have a selling signal when you cross over to the other side as well. So it's essentially works together with the MACD. So what you can do is you can have two indicators that are showing you whether you have reached the overbought or the oversold region. So those two indicators, if the other one, if they are converging, meaning that they are telling you that they are both in overbought region, then you can start buying, right? So that's good because now you have two indicators that are working simultaneously. They use different algorithms. So then when they tell you the same thing, then it sort of like gives you the confidence that you can actually buy. And then you also have your candlesticks that you will be looking at. So with those candlesticks, then you'll be able to analyze whether the candles that are forming that allow you to buy or not, right? And then we'll talk more about candles on our next lecture so that you can see how do you identify when the candles are allowing you to buy or not. All right, and then let's move on to the other indicator. You have your parabolic sum. So this is the technical indicator. and then it determines the direction of an asset. So with this Parabolic Sum, some they use it to set up their trailing stop losses. So meaning that if you are entering into the market, as you can see with these dotted lines, if you're entering into the market, say you're entering a buy, then you would want to put your stop loss where the dotted lines are, right? So if you're entering a buy here, then your stop loss you would want to put it here. So some they use it as a risk analysis tool, right? So now with the Parabolic Sum, it's very straightforward. So you have these dots on the downside of the trend and the upside of the trend, right? So the ones that are on the downside of the trend, they're usually signaling a buy. And then the ones that are on the upside of the trend, they're usually signaling a sell. So now you want to trade a pair when these, say these ones that are going down, the ones that are signaling sell, when they have exhausted, now they're no longer up there, it has changed the direction. So you have them on the downside. Then when they change direction to the downside, that's when you want to buy. So that's when now if you see these dots here, the next dot that forms, so they follow a candle. So this dot forms according to the candles, right? So the next dot that forms, you want to buy. So when you have this strong bullish candle, you had this one first, then you have a second strong bullish candle, then it signals you to buy. So when I was saying that some they use them as a risk analysis tool, is that when you buy here, right, then you put your stop loss at this level. Then if you check carefully, then you can see that okay, your market hardly reaches this level where your stop loss is, right? So then you just need to calculate the number of pips it takes from this level to your stop loss level. Then you will check if you can be able to afford that risk or not. And then usually you wait for them to cross over again. That's when you sell. So now you're gonna buy here and then wait for them to cross over. The moment they cross over, that's when you're selling. So it allows you to buy low and sell high, which is the good thing about this Parabolic Sum. It's very interesting to trade. I think you guys can follow it. And then you have your Fibonacci retracements, and then with Fibonacci retracements, they sort of like give you levels that are critical in the market. They're usually your support and resistance levels. So with these support and resistance levels, you can be able to see that the market respects this level. So when the market reaches those levels, it changes the direction, right? So say, for example, in this instance, you have your Fibonacci starting at a low here and then swinging at a high there. So you have these retracements levels, which is your 0.286 and your 0.382, 0.5, which is halfway in between, and then you have 0.618, 0.764. So with these levels, what happens is if the market crosses over to one level, it's most likely to bounce on the other level, right? So you can have what you call stop order trades that you put when you're trading this Fibonacci retracements level. So you know that okay, the market is most likely, so it's hardly that you will trade the 23.6% level. Mostly people trade the 38.2% level and the 50% level. So you know that okay, when the market is trending up, it can retrace for a moment and then go up again, right? So when it retraces, it's gonna bounce in one of these levels, right? So you identify a trend. So once you have identified that trend, so this is an upward trend. So you identify this trend and then you place your Fibonacci retracement levels. And then after you place them, then the market is gonna retrace going down. So when it retraces in a form of a trend, right? So it's just taking a break from trending upwards, and then it's gonna bounce back and continue trending up. So what you do is, you know that okay, the 23.6 level is hardly respected by the market. So what it does is it's gonna most likely bounce on the 38.2 or the 50% level. So what you do is you place your trades as stop orders on the 38.2 level, or either wait for it to bounce on this level. Then once it has bounced and then it has formed strong bullish candles, then you can start trading. So you can place a buy order. It means that you're continuing with the trend line that was going up. So the trend line is going up, so it can continue trending up, right? And then once you have bought, you also have the Fibonacci levels that show you where to take your profit, right? And then you can also do this manually by identifying your resistance and support levels. So this is how the Fibonacci retracement tool works, right? So it's used for technical analysis. They usually use it a lot in the market. It's a great tool to use, especially for measuring your risk and your reward ratio. So you can use it to measure your risk and reward ratio, right? So and then let's move on to the next indicator. So you have this is a downtrend one. So in your downtrend now you have this downtrend going down. So and then this downtrend you have your Fibonacci levels, retracement levels on this side. So when you have this retracement level, you can see that the 23.6% is hardly hit by the is hardly respected by the market. So they usually pass the 23.6 level with great momentum. So as you can see here, it just passed with a greater momentum, and it surpassed the 38.2 with a greater momentum as well. So after that, it hit the 0.5. Within that 0.5, it went down extremely with a high volume. So you can see the momentum here just increased, right? So it hit the 50% level. So if you check what's happening on the left hand side of the market, is that this level is also critical. So these are what we call your support and resistance level. So in this case here, this was a support level. So the market when it is doing the zigzag, it bounces off this level, and then in this case here, it's sort of like consolidated a bit. So it went there, and then they were not yet sure of whether they are buying or selling. So that's what the consolidation is. So the market is just bouncing off two prices for a certain period of time, and then it went down. So in this case, it went to the same level, which is similar to that level, and that level has formed what we call a resistance level. So it's difficult for the market to sort of like go above this level or beyond that level, right? So then that's when it reaches that 50 Fibonacci level. That's when you start selling in this market, right? So you can also be guided by a trend line. So as it's trending, retracing, you can draw a trend line. So when it reaches the 50 level, then you sort of like trade the breakout of the trend, right? So I'll show you some of these when we go to the platform as well, and when we're taking trades for ourselves. All right. So I think we can just set these things up. Do you guys have any questions so far of what we have covered? Are you guys here?
No. Yeah, you're here.
Okay. Are you following, Takara?
Yeah, I am.
Okay, cool. So I'm gonna share a screen for the market, and then we can try and set. I can show you how to set up these indicators. All right. Can you guys see my screen now? Are you guys able to see the chart on the screen?
I can't. It's black.
It's black.
Yeah.
Okay.
Oh, I can now.
Are you seeing the chart?
Yeah.
Yeah.
Okay, cool. let me just do this, and then I'll just. So I think the first indicator that that we covered was MACD. So let's look for MACD. So you're gonna go to Insert, and then you go to Indicators, and then you go to your Oscillators. Then you have your MACD. Then you click on MACD. So I think when we were covering it, we can just use the settings as they are. So with these settings, it shows these are the sensitive. What do you call your moving averages, which are those trend lines that you saw that cross each other. So you can increase sort of like the gap that they have in between each other, so that you can be able to catch more reliable trends. So when you play around with these numbers, then it means that you're widening the gap. So instead of the market catching smaller trends, it can catch bigger trends, right? Okay, and then you have your fast MACD, which is 12, and then your smaller your slow MACD, which is 9, and then sorry, it's 26 on the side. Okay, and then you have these are the lines that are there, and then okay, you can add levels, right? So you can add another level here. So in this case, let's just not add any level. And then yeah, visualization, it means that it's showing in all the charts that you have. So we can just go and click OK. I haven't changed any settings here, so we can just click OK, and then you have your MACD. That's it, right? So in the other one, you had 2 trend lines. So in this case here, this one is trending along with these bar charts, right, that you see here. Okay, and then so I think what we had is we're having a, let me see, this one doesn't have, or it didn't have an overbought and oversold levels. So I think we did the convergence one and the divergence one. So I'm just trying to see if I can get a clear convergence pattern here or divergence pattern. So as you go to the other time frame, it moves along with the time frame, right? Okay, can you guys please give me like 2 minutes? I'll be right back just now. Let me just do that. All right, apologies for that. So yeah, and then okay, so as you move on to a bigger time frame, your indicator adjusts this itself to the time frame, right? So as you can see, it's behaving differently from the previous time frame. Okay, so in this case, all right, I wanted to show you here, but this has already sort of happened. Let's just do that. Good. Okay, where is it? Okay, there we go. So, and then, okay, you have your trend line. So you can draw your trend line here on this. All right. As you're drawing your trend line. And then here, not so visible, but yeah. So we spotted that, okay, this is trending up and on this side. And now on the chart, what is happening is you sort of like have your downtrend, right? For that period. Okay, so now what you see is you have your trend line going down and you have your upward trend or on this MACD, right? So you're trying to do the convergence one, right? So now, so I'm trying to show you sort of like using almost a live market, right? So we're just assuming that whatever happened on the other side hasn't happened as yet, right? So what you have is you have that trend going up, and then you have this trend converging. So we know that when they are converging, it means that we're gonna have a bearish, a bullish trend after this, right? So what you see is that you have these two lines that you have. You have this one that is in form of bars. So you're following the trend on the bars one, right? So after that, on this bounce, on the second bounce, right? So you want this bar on the second bounce with the inner trend to bounce to cross over. When it starts crossing over, then it's sort of like signaling you to buy, right? So then it crosses over. So when it crosses over, then that's when you start buying, right? So you can either buy immediately as they cross over, or now you wait for other patterns to show you that, okay, you have a strong bullish trend. So say for example, in this instance, it's just a small trend, but if you extend it, and then just that we can't do that nicely. So if you had extended it and then they crossed over, you would just have to wait for the trend to be broken. So this is your downtrend. So you have your trend that is starting there, your second bounce is that, and then your third bounce is that. So, and then this is the bounce that was crossing over. So once it crosses over, then you wait for the trend line to be broken. The moment it gets broken, you would usually put your stop loss just below this this level here, and then you buy. After you buy, then you sort of like sell when it has crossed over to the other side, right? So when they start crossing over, the first crossover that you see on the upper side, then you start selling. I hope you guys can be able to see the convergence part of it. Okay, so
I have a question.
okay.
So what do you mean when you're talking of crossing over? Do you mean like crossing the red sort of line on the MACD?
Okay, on the MACD, so you see you're following these bar ones, right?
Yes.
As your trend, and then these when they cross over, so it's either so when this one, the red one, crosses over to the other side, so it's no longer within, it's on the other side. Do you get that?
No. What do you mean it's on the other side? Because I can see the white ones, like the white bars, and then I can see the red line, but
So
I'm not seeing where they are crossing over. Or maybe I should zoom in.
okay, let me see. I don't know if I can be able to zoom in properly. That. Okay, so I want to explain something. So you see when the red one is on the inside,
Okay.
it usually signals a trend, downtrend.
Okay.
Are you following that?
Yeah, I am.
So when it's on the inside, the market is downtrending. It's going down.
All right.
Okay, check here. When it's on the outside, the market is going upwards. So it's up, giving an upward trend, right?
Oh, okay.
You can check this range here, that when it was on the other side, the red the red line, it's the market is going up at that moment, right? So on this side here, when you're looking at the convergence, you were having a strong downtrend in this period, right? And then you had a little bit of upward trend, but then that little bit of upward trend, as you can see, it just formed a lower high, right? I think if you attended the first class, you remember that when you are identifying a downward trend, you see it with the lower highs and lower lows, right? So this is a lower high. This high is lower than that, right? So now what you see is that then here it's not showing any significant thing. So it's sort of like consolidating, right? So the market is not showing any significant trend here. It's a small trend. Then you have this line that you have to show your upward trend on the MACD, and you have your downward trend on the other side on the main chart. So the moment this red line crosses over to the outside, that's where now you start buying. So it has crossed over to the other side. So what it essentially means is that you're gonna have an upward trend. Are you following?
Yeah, I understand now. Thank you.
So after that, you have an upward trend. So when you sell, you can sell it when it crosses over on the other side.
Okay, I understand.
Okay, cool. That's great. And then so that's how the convergence one is. So on the upside, it behaves differently from the downside. So when it's on this side, when it crosses over outside the shaded area, then it's a buy. When it crosses over outside the shaded area, then it's a sell on this side. Are you guys following? It's only a sell for a few, because you still have a strong bearish bullish trend. So it's only a sell for a few period. So if you check here, you were selling, but then it did not move that much. Can you be able to see that on the trend? All right. So if you check, when it's on the inside, it's buying. So you are having an upward trend. Are you guys able to see that? Okay.
To see that.
So I'm trying to look for a pattern where we can see the divergence one, and I just spotted it. So now the divergence one here, we're having a downward trend, right? And on this side, we're having an upward trend. Can you guys see that? So you have that in the market happening. So when I shift the chart on the other side, is so that we can try to simulate a live market. So what you have is you have an upward trend, and then you have a downward trend on the MACD. So on the MACD, you're more interested in the trend crossing over to the other side, right? So that it comes on the downside. So when it comes on the downside, it means that you're essentially changing the trend. So you're no longer trending upwards, you're trending downwards. So we're still trending upwards here. So you have a strong upwards trend. So when this shaded line is on the upper side, it means that you were strongly buying. So the market was strongly bullish in this instance, right? Whereas in this, when it's on the other side, opposite side, it means there's a strong selling market, right? So what you have here is that you are waiting for these lines to cross over, right? So your trend is usually signified by 2 or 3 of these. So you're trending down here, right? So what you have is you have a trend that is going down. And then now I want to show you something which is interesting that could have happened. Say you saw the market this way, right? this is just, you have these two trends on the upside. It's going up, and then you have two points that are going down, right? So it means that the market is going down. And in this instance, when it's it's showing you the momentum of the buyers. So it means that the buyers are losing momentum in this instance, right? So when you see this, right, in the example that we got from the theory, is that you only obtain two points, and then that's your trend. And then here you have obtained 2 points as your trend, right? So now, as you are waiting for this to cross over on the other side, to show, to signal you a selling, a strong selling sentiment. Actually, it's when it's crossing over, it means it's buying. Let me just get that. Yeah. So when it's crossing over, in this instance, it's selling. Oh yes, it does the opposite of the downward one. So when it's crossing over, it means that you're selling, right? So now you have crossed over here, right? But you see that, okay, the market gave you these bullish candles. So my question to you is, would you buy in this instance, or are you gonna wait for another signal? So I want to show you something that is important, right? So what you have is, when you're analyzing, you don't only use indicators by themselves alone. So when you have this indicator here, so as you're analyzing, you have these lines, this level being respected by the market. So this forms as your support and resistance level, right? So the market went and bounced there, it went down and bounced there again, went down, right? So it's respecting this level. But then if you were trading, there's something what we call double top. So you would have thought that this was a double top, but then it was a false one, right? So if it was a double top, it was gonna break below the neckline here, right? So you'll see, you get more of this as we look at the chart patterns. And then now what it did is, when it bounced off through this trend line, it went up, it went down, and then respected this level. So when it respected this level, you don't want to be trading as it's respecting this level. You want to trade once the candles have formed a strong bullish candle on the downside. I hope you're following. So if the market forms a strong bullish candle on the downside, meaning that below this line, then you can start trading. Say, for example, in this case, you could have started trading here. But then here, that's when it was still bullish, because you hadn't started your trend going, meaning that the market it's becoming bearish. So here it was still bullish. So it means that people were still selling, buying here, right? So you wouldn't trade here. But now here, it's showing you that, okay, we are changing the direction. We have trended downwards. So here, that's when now you're asking yourself whether you should take this trade or not. So the second, the market doesn't go down below this support level. So the support still held for some time. As you can see, it went on for some time. So if you were trading, you were not gonna trade this support here, right? And then now this is perfect, right? So we continue trending down, as you can see here, and then here we are still trending up. So it went up, meaning that trade, it was a false break, it was a false trade, sell trade. So you're not gonna take it. So when the market went up again and then it went down, right? You have this trend that has been formed here. We're still respecting that, and this is still divergence on MACD. So what you do is, you still have this support and resistance line that you have here drawn. So you wait for the market to break below that with a strong bearish candle. This is a strong bearish candle. So it tells you that the market has significantly changed the direction. So what's going to happen is that if you check on this MACD indicator here, you have crossed over now, right? So when you have crossed over, this is the second crossover. You had this first crossover, now you have this second crossover that is signaling you to sell, right? So once it signaled you to sell, then you wait for this trend, for this candle to close. When it has closed, it shows you that it has broken that line that you had as your support and resistance. That's where now you can trade and sell, right? So this is a candle confirming what your MACD was showing you, a sell. So once you sell, then you put your take profit, your stop loss just above this line, and then now you put your take profit as you take a profit just when they cross, right? So in this instance, people usually trade these MACD on smaller time frames, right? But then you can also have algorithms that tell you when these lines cross. So the moment they cross, you can take profits, right? But this was a false breakout on the long trend, right? So I just want to show you the trend that I'm talking about. You have this trend, and you had that. So this is more like a retracement, right? And then I'll show you how the retracement worked on Fibonacci, right? So I think time is running out. So okay, I can just explain this, and then we can just end the class, because I also have I can explain this just now. So you had this trend going up, so it did break out on that trend, and it did break out here on that support and resistance line of yours, and now it showed you this side that you're going down, and then you sell, right? As you sold, the most interesting thing is you sold, but you're gonna only take this is an hourly chart, so you're gonna take about, you're gonna sell your close your position when it reaches this level, because this is where they cross over. So you're gonna take about 695 points in the market, which is good. So if this was a daily trade, then you're gonna make on a 0.1 lot, it's about 69 rands, and then on a 0.01 it's about 69 rands, on a 0.1 it's about 695 rands. Yeah, so that's how it works. And then if you had sold here, then what you're gonna see is, if you apply your Fibonacci, or I can just save up this trend. Okay, we're gonna apply it on the other side. Fibonacci retracement levels. Okay, so that's your Fibonacci. The chart looks a bit messy, right? The actual trend is this one. So that's your trend, right? Your trend is starting somewhere here. You just put it there. So on your Fibonacci retracement, what you are gonna be having essentially is that after it broke out, okay, so many lines. Let me just delete some of the lines. Fibonacci shows you the trend line as well. So as you can see, it shows you the trend line of the market. So what you see is that the market retraced, and as it retraced, then you have your 23 not being respected, as I mentioned. Then it sort of like bounces, it doesn't really touch it, but it bounces just closer to the 38.2, and it went up, right? So this would have been your entrance point for another trade, right? So I just wanted to show you a bit of how Fibonacci works. Okay, do you guys have any questions? Were you guys able to follow up to here? I'll explain more of Fibonacci when we have our next session. So let me just remove that. Okay, if you don't have any questions, then I will upload this video after this, maybe today or tomorrow. All right, thanks for coming through. Cheers.
And thank you very much, Mugove. We'll see you next session.
All right, sure. Make sure you do catch up on the other videos as well.
Yeah, we'll do that. And thank you.
Sure.